I anticipate, as I have anticipated for some time, that we will have what they call elevated inflation between 6 and 9% through 2023, maybe going into early 2024. And the reason for that, David, is that no matter what the Fed does actually now, there's such a huge monetary overhang waiting to come out the monetary inflation overflow valve in the monetary bathtub that it'll just keep feeding the inflation. So it's not going away anytime soon, to make a long story short. The big story is in anticipation of the number coming out today. President Biden gave a speech yesterday,
yes,
in which he finally admitted that inflation was not temporary and it was the number one problem in the United States. He got that right, and he got essentially everything else wrong. He said that inflation was caused by COVID and the war in Ukraine. Now, let us just look at that for a minute. COVID, what happened during COVID? What was that all about? We go back to February of 2020. Biden starts spending money like a drunken sailor in Washington, D.C. Who finances that? About 90% of that was financed by the Fed turning on the money pump and the printing presses. And we had an explosion in the money supply. And we know that after a lag of about 12 to 24 months, inflation comes after those huge surges in the money supply. Now, the interesting thing is that the Fed financed all this spending, and we have 416 economists at the Fed in Washington, D.C., and none of them got it right. As you well know, John Greenwood and I, almost a year ago in the Wall Street Journal, got the thing exactly on. We said inflation was going to be between 6% and maybe as high as 9%. Not one of those 416 economists at the Fed got it right. So you say, what are they doing down there? They are worried about climate change. They're worried about gender studies. They're worried about social justice issues. These guys are all woke warriors now. They're not paying attention to their mandate, which was laid down in 1946 in the Full Employment Act. They are supposed to be keeping their eye on inflation and employment, and they are not doing that. They are off in the clouds.
The Fed is worried about
climate change.
You're saying the Fed, the Federal Reserve Board is worried about gender issues and equality and social change and stuff that the government should be worried about? Is that, just to clarify, that's what you're saying?
Yes, the Fed, that is not in the Fed's mandate. They're not supposed to be worried about that kind of thing.
But
they've
why?
been pressured by the Biden White House to get on that bandwagon. That's a big woke bandwagon.
That seems strange because I don't know what the Fed can do to help steer the country in a social direction that the Biden administration would like. What tools do they have to enact social change? I mean, let's talk about that.
That's what they're doing. They're looking for the tools. They haven't found them yet. But that's what they're doing. They're spending a lot of time on that. The Fed has become very politicized. Now, that's the COVID side of the story. What about the war in Ukraine? Well, yes, thanks to the sanctions that the Biden administration and Europe have aggressively put on the Russians, we have seen a big increase in oil and gas prices, and wheat prices are at an all-time high. Corn prices are at an all-time high. Food prices are going through the roof. And that is, again, it's you say the war in Ukraine. Well, what about the war in Ukraine? Well, the thing that's causing the relative price increases in these sensitive commodities it's the sanctions. Who put the sanctions on? The White House put the sanctions on. So all this comes back to the doorstep of the White House in Washington, D.C. The COVID thing, remember, a lot of spending, a lot of Fed financing, a huge increase in the money supply, you get inflation. Sanctions are related to the war in Ukraine, and the sanctions are driving up oil and gas prices and a lot of commodity prices. So the source of the problem is really policy coming out of Washington, D.C., one way or another. And you have a doctor who's diagnosed the problem completely wrong. That's Biden. I mean, he's already entered my encyclopedia of economic stupidity. And that speech that he gave yesterday was just incredible. He wants to fight inflation by increasing subsidies for green energy, increasing taxes, this wealth tax that he's proposing, which may be unconstitutional, by the way. He's pushing that. That's the second thing. And the third thing is to increase regulations, price controls, more price controls. So he's just got the whole thing wrong. You control inflation by going to the cause. The cause is a massive increase in the money supply. It's been growing on average over the last 2 years, a little over 18%, almost 19% per annum. And the golden growth rate, David, as we've gone over, they should be growing that money supply M2 at about 5 to 6% if they wanted to hit an inflation target of 2%. So they're just really out to lunch. And as I say, 416 woke warriors, economists, they call themselves in the Federal Reserve System, none of them got it. None of them predicted any of this. If you look, by the way, the big lead column in the New York Times today, front page, is, oh, gee, inflation doesn't look like it's temporary. They finally got around. They've had hundreds of articles in the New York Times about inflation, looking for inflation in all the wrong places. COVID, the war in Ukraine.
Just maybe they're a contrarian indicator, because previously they were wrong and maybe now they're wrong again. So maybe now it's temporary. I jest. But okay, Professor, that was a joke. Let's talk about Biden's policies and Russia. So by the way, so Biden has entered your Encyclopedia of Economic Stupidity. I remember you said President Bukele of El Salvador has also entered that entry. He's in there big time. Yeah, they're both.
They're a number. Bukele has a number
honored members of your encyclopedia. But that's a different conversation for another time. The war in Ukraine. So you yourself said that inflation is caused by an increase in the money supply, but then you also said that this war has exacerbated food price increases, especially wheat, barley, fertilizers as well, sunflower oil, and all that, the stuff that comes out of Ukraine. You're absolutely right. So let me ask you this. Oil is another issue that people are watching out for. Oil has spiked recently, especially during talks of a potential ban on Russian oil. If we do have a ban, if the Europeans do ban Russian oil, if they do impose some sort of embargo, are we going to see the late 70s again, when the OPEC had an embargo on oil, and then we saw basically stagflation, really, really high energy prices, really, really high CPI, and of course, no growth?
Well, we'll see high oil prices. As far as Europe goes, by the way, this is a suicide message. Europe will just collapse, but that's a kind of a separate issue. Let's talk about the inflation part of the thing.
Yeah,
OPEC in the 70s, David. There were two crises. One embargo early in the 70s, and then one in 79, 80. And if you look at Japan, for example, it's a great natural experiment. In the first OPEC crisis, there was considerable increase in inflation in Japan. So you had the relative prices of oil going up relative to everything else. You also had a bump up in inflation, but that was due to the fact that the money supply increased considerably in Japan during that period of time. The second time the oil price bump up occurred in 79, 80, there was not very much increase in inflation, and that's because the money supply was kept under control in Japan. So the key here is not to get confused about oil. Oil prices don't cause inflation. The money supply causes inflation. The oil prices, when they go up, that's just a supply and demand factor. The supply is restricted. What happens? The price goes up relative to everything else. But inflation may or may not occur, and that is due to the growth in the money supply. If the money supply doesn't grow very much, you're not going to have inflation. You'll just have a big price increase in oil.
Well, would you not agree that if oil and food go up, everything else needs to follow? I mean, think about it. I mean, no,
it doesn't. If the money supply isn't good, if the money supply is well behaved, everything else doesn't have to go up, and it won't go up. By the way,
well, people in theory, I mean, in theory, people.
The only thing that the oil price and food prices do is they kind of unhinge and unanchor inflation expectations. So people going to the gas pump now. We've just hit a record high in gasoline prices in the United States, and you're filling up your car every week or every few days, and you see that price increase, and you say, "Oh, we must be having inflation. We must be having inflation." And then the next time you negotiate your wage contract, realizing that your wage has not been going up as fast as inflation.
Well, that's it.
You negotiate a higher wage.
People are going to start negotiating for higher wages. Wages are going to go up. That's going to push up everything else.
Right. So
vicious cycle.
So the thing is dynamic. I'm not saying that these relative price changes have no effect on anything. Obviously, they affect the dynamics involved in the thing. And what does this mean? It means if the money supply is going up, the duration of inflation following that excessive growth in the money supply can be longer than it would otherwise be if the inflation expectations become unanchored, which it looks to me like, by the way, they're pretty close to start. They're starting to become unanchored. And the main reason is that wages have not been going up as fast as inflation in the United States. And people are a lot smarter than President Biden. He doesn't quite get out. He's really not the sharpest knife in the drawer. And normal people realize that inflation is kind of taking them to the cleaners, you see. So the next year, they're going to want more wage increase to beat inflation.
That is a fair point, Professor. I was at the gas station the other day and I saw this man get robbed, and he called the police and he said, "I just got robbed. Can you come help me?" The police said, "What was what happened? Give me a report." He said, "Gas pump number 6 robbed me." All right. I'm glad that joke worked on you.
Yeah, well,
Okay, so let's talk about fiscal and monetary policies now. You have said to me before that interest rates alone do not affect inflation. You need to control the money supply. So the Fed's raising interest rates. They're raising it by 6 times, and I think their projection, most people agree that 6 to 7 times is likely. People I've talked to at least. So that's not going to do anything, you say. So what should they be focusing on instead? Tapering down the money supply?
They have to be focusing on taking the money supply down. But I'm not arguing that those Fed fund increases don't do anything. They do things, but we don't know what they do exactly. There's a loose link and an uncertainty associated with increasing federal funds rate and changes in the money supply. Because there have been cases, by the way, where they've increased the federal funds rates very dramatically in the United States, and the money supply really didn't come down. And why didn't it come down? Those Fed fund rate increases affect the commercial banking system, and the commercial banking system is a big producer of the money supply. That's where it comes from. Most of it comes from the commercial banks, not the Fed in normal times. So if the demand for credit is strong, even if you are increasing the federal funds rate, and even if increases in interest rates occur in the marketplace, they might still not slow down the money supply growth very much.
Well,
they have to be keeping their eye on, if they're going to use the federal funds rate as an instrument to control monetary policy, they have to be watching the money supply, and they are not watching the money supply. I've said this over and over again. You know, you're flying an airplane without an altimeter. The altimeter should have the money supply in there, so you know what your elevation is and what's going on. The Fed is not looking at the money supply. They don't even release it every week anymore. They only release it once a month.
Well, why did Volcker raise the Fed funds rate to double digits back in the 80s?
To slow the money supply growth.
So is that what we need right now to have?
He did have the money supply on the altimeter. He was practicing monetarism. The quantity theory of money was the bedrock for what Volcker was doing when he was trying to control inflation. He realized that the money supply growth had been excessive, and when he came in, his main job was to control inflation, and the way to do that was to get the money supply tamped down.
Maybe we need 8% interest rates then, 8% Fed funds rate today.
Well, I don't know, because we don't know exactly what that linkage is between the federal funds rate and the money supply growth. So and by the way, the federal funds rate is a very bad indicator for the tenor and tone of monetary policy, whether monetary policy is tight or loose. That you can increase federal funds rates and still have loose money if the money supply is growing fast. So the federal funds rate really are a very bad indicator of what's going on. And that's why, if you're flying an airplane and that's all you're looking at, and you're out in Colorado or up in British Columbia in the Rockies, you might hit one of those things.
What if it's not the money supply, Professor? What if it's just corporate greed and capitalism? Take a look at this quote from Senator Elizabeth Warren that she made on the 30th of April. She said, "One of the reasons why prices are up, corporations have figured out they can use inflation as cover to not only pass along their own increased costs to consumers, but also to price gouge to boost their profit margins. We need tougher rules to prevent price gouging." So she's passing the blame, I think she's passing the blame on to corporations for inflation.
Well, you have to remember, Senator Warren is in that loony left camp. And, you know, you've got loonies up in Canada, but we've got them down here too. And this is exactly what Biden has been saying at the White House. This has been, they're looking at for the causes of inflation in all the wrong places. Monopoly power is not the reason why you have overall inflation. At best, let us assume you had a monopolist, by the way. Just assume you have a monopoly. What does that do? That increases the price of whatever that monopolist is producing and charging for relative to everything else. But it certainly doesn't cause inflation. It's like this relative price change in oil going up. That's one price. It goes up. It went up in the 1970s because of what? We had an OPEC cartel. That was a monopoly pricing power. But this is just, again, I'm making a note. I will put Senator Warren has not been entered into my Encyclopedia of Economic Stupidity. She's just entered it. Thanks for reminding me. This is a full-time job. Keeping this encyclopedia up to date, David, is a terrible task. I have to work on it every night, and it keeps me up quite late.
Well, so far you've got, what, 3 names now? I wonder who's next to make the honored list. We'll keep tabs on that list as we progress.
Well, David, don't hold your breath.
Look, what can the government do now to fix inflation? Biden has said that this is now a number one domestic priority. Okay, if not, Senator Warren has suggested that the government tighten up rules to prevent price gouging. I'm not exactly sure what that means or translates to in terms of policy, but they are certainly thinking of doing something.
I'll tell you what they want to do. I'll tell you what they want to do with that. That's under, remember I said they had 3 things that they were focused on to fight inflation. Boost subsidies for green energy, raise taxes on the ultra rich, and increase regulation. Well, regulation includes lots of things. One is price controls, which I mentioned. The other regulatory thing is the imposition of antitrust policies. So they want to go after whoever they think, like the oil price. Oil prices are determined in an international market, but they've proposed to go after the oil companies because supposedly the oil companies are monopolists. So that they would use antitrust laws to attack the purveyors of monopoly prices, whoever they happen to be, whether it's oil companies or others.
Okay, so forget what they're not supposed to be doing. What should they be doing? If the government asks you to design a policy that would help on the fiscal side, at least, not the monetary side, on the fiscal side to, I guess, help bring down inflation, given that it's a top national priority now, what would that policy be, or a series of policies?
Well, the fiscal side is easy. They've jacked up spending tremendously, and so I would unjack it dramatically.
Okay.
So that the spending side, if you're gonna, get those drunken sailors off the street and stop spending so much money. That's point number 1, because if they're spending a lot of money, spending a lot, creating a huge deficit in the United States, there'll be a lot of pressure on the Fed to do exactly what they did in 2020, or particularly in 2020, but even in 2021, and that's finance the deficit with the printing press at the Fed. So the second thing, you want to slow down government spending, but you also want to slow down the printing presses and get the money supply growth measured by M2 down to around 5 or 6%. And then what would happen? Then we would have gradually inflation coming out of the system, and probably by early 2024, things could maybe be close to inflation targeting of around 2% if they did that.
All right. Let's close the conversation today on gold. Your gold sentiment index has been very popular. A lot of people watching our show have been asking about it. What has the index been telling you of late?
The index has been bouncing around a lot, and in a way, this is the most useful aspect of the Hanke Gold Sentiment Index, and that is it's a great contrary indicator. Now, what I mean by that, the scores go from -10 to +10, so that's the full range. And when you get over on extremes, let's say we have a tremendous amount of enthusiasm in the market, and the indicator that we're reading every hour, by the way, the needle goes over close to +10. What do you do then? You sell. It's a switching point. It's a contrary indicator, because it will revert back towards the neutral side. Or if you have a tremendous amount of fear in the market and the market's very bearish, and it's like a -10. What do? You buy. And these signals that we've been getting are extremely accurate and tradable. We've back tested the model now, David, and we're actually also trading it
right
in real time, and it's turned out to be quite profitable. These signals at the extremes are very useful. So that's what's been happening. The needle's been going plus to minus, and what do? As a trader, you're buying, selling, buying, selling, buying, selling. And as it turns out, the thing's working.
Okay, so Professor, what's the latest reading on your sentiment index?
Well, at 8 a.m. this morning, it was -5.6. Then at 9 a.m., that's 30 minutes after the inflation number came out at 8.3%, it went down to 7.55. And at 10, it was -8.7. That is an extreme. You want to be buying now. And in fact, we did buy, and the spot goal went from 834 to 850 almost immediately.
It's not, but the if it's -8, isn't that very bearish?
This is a contrary indicator. Remember, the extremes are contrary indicators.
I see.
And when we have an extremely bearish reading, that is when you want to be in a position of covering your shorts and going long. And that's exactly what we did.
All right, so bottom line from today's conversation, inflation is not going away anytime soon, and you should be buying gold right now because the Hanke Confidence Gold Sentiment Index, being a contrarian indicator at the extremes, is very extremely bearish right now. Does that sum up pretty much your thoughts today?
Yeah, that sums it up, David. But remember, when we're talking, this is for gold traders who are in and out of the market. Maybe they're long, maybe they're short, all in one day.
Right. Well,
so right now, we as a trader, we went long. And of course, we caught it because the indicator was an extreme bearish, and we know that it will be coming back towards more bullish. And sure enough, we caught the bottom of the market.